Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone. Ira Epstein, and here we are at the end of the trading day on Monday, the 23rd of January, 2012. The time right now is looking at my watch, 3:45. Getting a little bit of a break. I just did the financial video, and in looking at it, we were a bit higher in the stock market, unchanged. We're only 5-10 minutes later, and now we're a bit down on it. It's just an interesting day, any way that you cut it. I think we're getting to the point in the stock indices where they're rich. And that doesn't mean they can't go higher, but I think they're too rich to get into up at current levels. I think you need to get a pullback in the market. And I'm just as concerned about the silver, gold, and the copper, just chasing the markets blindly up here, and I'd never advise that. The dollar has been breaking, and that's what's caused the rally in the metals and the euro rally. You know, one of the big bets, if you were watching any of the financial programs that I do, CNBC, Bloomberg, Fox, First Business, I'm on Sky TV, one of the big plays you got asked the first week of the year was the euro and where you thought it was, and it was trader after trader bearish. I'm bearish too, but not at 126, not 128. I thought that the market can get into the low 130s, and maybe there's where the market stalls out again and begins another foray to the downside. So far, you have to admit it, for the past week and a half or so, things about Europe have fallen to the wayside. Interest rates there have been coming down. That has allowed the dollar to fall, their rates to stabilize, if you will, in terms of not getting over that magic 7% number. And at the same time, gold being priced in dollars is saying, well, gee, maybe this is a reason to rally. I think the rally was there more for the silver and copper than the gold, and I won't change my opinion on that. But gold has come off the lows beautifully. You're about $150 off the low here that you made in late December. You can see how the markets climb back up into this general area. I'm looking for the resistance right in this zone. If I step back here into November, you can see this area was an area that you got up, bounced from, and when you finally broke, it caused the break. Well, that number is 1677 and a half, roughly, 1670, let's call it 1675. You're in that general zone right now. I'd be very cautious about buying the market just blindly up here. As long as you don't take out 1645.20 on pullbacks, I could see nibbling into the long side. In fact, I had talked about that today in my newsletter. I am bothered by the 18-day average of closes, which doesn't seem to be able to get up and meet the swing line low. So you're forced to just buy on another moving average of some type, or one of your other entry points with stops under that number if you're playing the swing line. Well, now, what is the swing line, the brown line? It measures what a trend is in terms of what's it doing and what's the risk associated with the trend. An uptrend is made when markets make higher highs and higher lows. The risk associated with it from the swing line perspective is that to keep that trend, what you don't want to do is break the pattern. So 1645.20 would break the pattern of higher highs and higher lows. The market fought last week against the 45-day average of closes, this blue line, and today it was able to just get up, go, and now that could be a theoretical support at 1658.70, and the next resistance level comes in one of two areas. One of the areas is the 100-day moving average of closes, which is a very powerful moving average. A lot of traders look at longer-term averages to see what's going to happen. The second number would be the Bollinger Band, which is 1694.60. They're pretty close to each other. So I'm going to say that somewhere between 1695 and 1705 is where I think the market, if it can get that next leg up from today, will peter out. Now, it's only at 1677.60. Nobody says it has to go that high. And the short-term trend is up. Profit objectives, giving you what I see. And as long as the slow stochastic study, which is made up of two lines, the red and the brown line, you can see them easier right here. As long as the red doesn't turn under 80, the market's momentum remains up. When it gets under 80, I think you'll make a run for wherever the 18-day average is to try to get back down to it. You obviously haven't done that yet. You're liable to say, Ira, will the brown turn with the red? No, the red will turn first. The red whips around the brown, and that's because the red line uses 3 days worth of data in the formula. The brown uses 5, so it's a longer term number, the 5. In the silver market, you've got your embedded stochastic. The market is over the Bollinger top. Now, the odds of staying over a Bollinger top are about 2.5% of the time, and in consecutive days, it gets shorter. Let me show you something on copper. In copper, you had 1, 2, 3, 4, 5. Go to my tapes. I was arguing. I said, folks, that 6th day, the percentages are strongly against the market staying, what? Over that top. Now, the important thing is that was a key reversal. The market made the highest high of the move, took out the previous low, even closed under it. So 383 and a fraction is the key number. If the market can get over that, watch out. You might get another boom to the upside. I don't think it's going to happen. I think the market's going to run out of momentum against that number and the Bollinger Band. And because you haven't had a real serious break other than the past 2 days, you're left with 337.80 as one of the swing line lows. And it's very possible that today's low of 372.20 could become the next one. It wouldn't surprise me. If you don't take out today's low, that will become it on the chart. Then if you took that out, you might work back into the 350s. What am I saying in plain English? I am a super bull on copper. I picked it at the beginning of the year on some TV shows as my favorite trade. However, I did not expect this. So if you were to say, was I left at the gate standing with my jaw wide open, watching the train leave, and not involved in the trade? That simple. It was overbought in this condition. I can give you all the reasons. It doesn't matter. The trade got away. So you wait for the next one. There's a plain schedule for a reason. There's always something else coming. Platinum market, before I finish up this segment and move on for something for you, it's doing the same thing. But what I didn't like is, in order to get long, I was looking, you had to be a buyer over Friday's high of 1539 with the stop under 1506.50 to get up to the Bollinger top of near 1575, which you just missed today so far by $7. The risk reward, though, was huge, just way too huge for me to tell anybody to go with. But we talk about these type of things in our market outlook. You know, the Lynn Group, not me, the Lynn Group writes this report. And they cover all these different markets. And it's a one-page report. It's very simple to read. They use longer-term charts to give you an idea of what they're seeing, how their price counts come out, and where they're at for the next 6 months. I then come in and give you twice daily what I'm seeing of the markets on a shorter term. Put together, you get a game plan. If you'd like to get a copy of this, you call us at 1-866-973-2077. That's 1-866-973-2077, or go to our website, www.iraepstein.com, and sign up for our kit. With that, I'm Ira Epstein. I will talk to you tomorrow. Have a good day.